In today's video, we will be going through a great way of looking at what you're actually doing when you lend money to a bank versus buy the business of the bank, and which could be better for your overall growth. Let's jump right in. Hi, I'm Joe Macek, Portfolio Manager with IA Private Wealth. And today, for those of you that are hesitant to own shares of companies or stocks, I'm going to make what I feel is a super strong case as to why buying the bank's GICs instead of owning their shares could be an investment move you may not want to make. But before we get into it, I'd like to mention that while I am fully licensed in the areas of investments and life insurance, and I have over 2 decades of experience helping many clients, I'm not licensed in any other area. And so with that being said, this video and any other video I produce should be purely viewed as educational for general information purposes only, and it should never be viewed as actionable advice in any specific area. So please, before you make any decisions surrounding your money based on any video you see on YouTube, take the time to consult with a fully licensed professional, or feel free to reach out to me on a one-on-one basis. The other thing you need to do is hit that like button for the YouTube algorithm, as it really helps out my channel. And if you love my content and you want to be kept in the loop with all of my newest videos, I would be thrilled if you'd hit that subscribe button and darken that notification bell. Okay, so with that out of the way, we're going to walk through a great tip on how you could comfortably buy and own shares if you've ever wanted to but were afraid to do so. The first thing we should look at is why people are usually afraid to get into the stock market in the first place. And as a result of that fear, buy GICs, or guaranteed investment certificates. Well, many people when first starting out are afraid of what they don't know. And the stock market can seem to be a very scary place to put your money, especially if you don't know exactly what you're doing. And it's no wonder why. As for as long as the stock market has been around, it seems the mainstream media only like to report shocking and horrific news when it came to the markets, which generally meant only reporting on the incredible crashes and implosions of capital that have happened over the past century. In fact, it seems very rarely do record highs ever get the same attention as crashes do, mainly because the markets seem to make record highs a lot more often than market crashes, and when they do, they aren't typically fast. It usually takes a little longer to get there. There's an old saying in the investment world that goes something like this: when the markets go up, it takes the stairs, but when the markets go down, they take the elevator. I think it's for this reason that many potential investors choose to shy away from investing in companies because of the fear of loss of their hard-earned money, and therefore choose instead to invest in fixed-rate securities like GICs, because the GIC is in fact what it states, a guaranteed investment certificate. These GIC securities are extraordinarily unlikely to drop in value, and you are paid principal and interest guaranteed by the bank for the length of the term. While this might seem like a great idea at first for those of you whom are familiar with this fear of loss and have purchased GICs as a result, or if you just haven't been aware of how to take advantage of owning shares of companies, I will right now illustrate what I think is a very strong case as to why buying businesses may often be a lot better for you over a long period of time. Let's start off with what a GIC really is, and for our example today, I will be using the Bank of Nova Scotia. There is no particular reason why I chose Scotiabank. It's one of the big 6 Canadian banks, and you can do this example with any Canadian big bank. I just happen to choose Scotiabank. So now let's take a look at Scotiabank's GIC rates, and you will notice as of this writing, Scotiabank has several options when it comes to GICs and rates, how they are paid, and so on. You will notice you have redeemable or cashable GICs, and then you will have ones that are non-redeemable, or basically your money is locked into that rate until maturity. The longest length of a GIC you have here is about 5 years, and we will focus on the non-redeemable GIC and push out a very theoretical 10-year GIC to help illustrate our case. Now, it's important to note that Scotiabank does not offer 10-year GICs, but we can simply go to the Canadian bond yield curve and find out what the current Canadian rate is on 10-year fixed income. This will give us an apples-to-apples comparison when going for a length of time invested. And as you can see as of this writing, the 10-year rate on Government of Canada bonds is around 70 basis points, or 0.70%. And our 5-year fixed rate at Scotiabank is a little higher, around 80 basis points or 0.80%. Now let's assume you could get a 10-year GIC, and let's be generous and give you 20 basis points higher than the 10-year rate, and let's say that the special 10-year GIC at Scotiabank will pay you 90 basis points or 0.9% over 10 years. What's really important to note here is by purchasing the GIC for 10 years, you are locking up your money for that 10-year period. The bank is essentially taking the money you deposited for 10 years and borrowing from you your money at 0.9%. And then they take it and reloan it out to other people that, for example, may need a mortgage, charging anywhere from about 3% to almost 6% on the different mortgage terms that they offer at the bank, thereby making their spread. And once you lock your money up, the bank will only pay you that principal and the interest owed, guaranteed until the end of the term. As nice as Scotiabank is, they will never phone you up in the middle of the term if interest rates rise and pay you more interest, nor will they pay you any less interest if interest rates fall. For that 10-year period, they know and you know you will always get 0.90% annually for the term of the GIC. Another way to look at it is most people, when they borrow money from the bank, they rate shop and they want to pay the minimum amount of interest possible on their mortgage. That's exactly what the bank is doing to you when you buy a GIC from them. They are rate shopping you to pay you the least amount of interest they can for 10 years. So for example, if you had $10,000 for 10 years, every year annually, you would get an interest payment of $90. And at the end of the term, your principal back for a grand total of $10,900 with no real risk of loss. Again, they will never pay you any more or any less. And there's a reason as to why I'm making this point, which I will get to in a minute or so stay tuned. Let's take that same $10,000 and instead of loaning our money to the bank so the bank can use that money to reloan it out and increase their own profits, let's make you a shareholder in Scotiabank's profits by buying you the stock instead of their GICs. And now we will walk through the two huge reasons as to why it could be preferable to own the shares of the big banks versus loan your money to them. By owning the shares of the business, you now own the potential profits and, of course, the potential losses of Scotiabank. Scotiabank, at the time of this writing, currently trades at $68.54, and the current dividend is $3.60, representing a current dividend yield of about 5.2524%, or 5.25%. This is approximately 5.83 times larger than the 90 basis points, or 0.9%, on a theoretical 10-year GIC from the bank. It's also 6.56 times higher than the 5-year GIC rate of 80 basis points. Now, we're not even going to get into the tax treatment of Canadian dividends, but we will let you know that the dividends are also taxed at a lower rate than the interest income that you will receive for your GIC. However, for the purposes of this video, we will assume no taxes are owed and what you receive in payments are fully yours. So for you to be paid the equivalent amount of dividend money for the entire 10 years of GIC money, in theory, you would only have to own Scotiabank shares for 20.58 months. That's right, less than 2 years to be paid the equivalent of the entire 10-year GIC interest income from the GIC versus the dividend income.
Yeah, but Joe, buying stocks in the stock market is risky, and the value of the shares could go down, and we could have less money tomorrow from these shares than we do today.
Well, yes, and while it is true that owning bank shares in the stock market exposes you to extra volatility risks over a shorter period of time, like 3 to 5 years, and while your risks of owning those shares are certainly greater than the risks of owning GICs, the returns over a long period of time are likely to be better, especially when you hold the shares over a 10-year time frame. In fact, while not impossible, it has been rare that you've taken any 10-year time frame with the Canadian banks and actually lost money by owning them. But even if you were unlucky enough to have that happen, if you held on long enough, even if you bought at the last peak, as you can see here in 2007, you would still be up today had you held on. So by buying shares in Scotiabank and owning them for the long term, the probability that your principal increases after 10 years is very good. Compare that with the Scotiabank 10-year 10-year GIC, or any GIC for that matter, the probability that your principal will increase after 10 years is very likely 0. And there is your first reason. By owning shares of the bank's business for a long period of time, there could be a better probability of increasing your principal, while in GICs, you simply just have no chance. And now here's the second reason. Remember I mentioned to you that when you loan your money to the bank for a fixed rate GIC, once you have your rate established, they would never likely increase that rate in the middle of the term? Well, let's take a close look at the last 10 years of dividends from the Bank of Nova Scotia. As you can see, 10 years ago, Scotiabank only paid out $1.96 per share for the dividend, but steadily and regularly as the banks increased their profits over the years, the regular dividend has been increased to $3.49 in 2019, representing an overall dividend increase of 78%. So reason number 2, put simply, is the longer you own the shares of the banks, the higher the probability that they increase their rate of their dividends, and the higher the probability that you increase your overall yield on your average cost and make more money per share. Fixed rate GICs won't increase their rate of interest paid at all for that 10-year period. So for those of you whom are still skittish of buying shares, I will leave you with one last thought. When you buy shares of any business, the single largest risk you face is that that business that you bought goes out of business. And that's when your shares go to 0. If I were to ask you a question right now, what do you think the odds are that the Bank of Nova Scotia, Chartered One Canadian Bank, goes completely out of business and is bankrupt within the next 10 years? If you're like me and you think that is extraordinarily unlikely, I think we have covered off most of the major hangups you might have about buying these types of shares. So with that said, I want to thank you for tuning in at this time, and just a reminder that if you like this video, please hit that like button for the YouTube algorithm, as it really helps out my channel. And if you want to be kept in the loop with all of my latest videos, I would be thrilled if you just hit that subscribe button and darken that notification bell. Until next time, this is Investing Made Simple. I'm Joe Macek, Portfolio Manager. We'll see you soon.